All right, it gives me great pleasure to bring on board Mark Matthews of Julius Baer. Mark, fantastic to have you back. Thank you for joining us. Mark, this week's action on Wall Street certainly is creating some uneasiness for market watchers. It's giving you that, uneasy feeling at the bottom of your pit where you don't know what's coming next. Everyone is trying to say that should they buy the sharp decline or this is the end of the road for markets this year. What's your sense?
My sense is that the fundamental picture is unchanged. What happened instead was a excessive enthusiasm toward the technology sector in general, driven by these online brokerages that are offering zero commission trading. And so Ameritrade, Robinhood, that kind of thing. And we can see particularly in the options market, there's been a real spike in call options. In other words, bullish contracts. And these will be expiring next Thursday. And so I still think we can get quite a bit of chop in the US market as these retail investors who don't want to actually pony up the capital to hold the underlying share get out of these options. But going back to the fundamentals, they are intact. And the liquidity is intact that's being provided by the central banks. So what we're getting is a shakeout from retail, and that can often be quite brutal. But we would want to stay the course in the market because, as I said, it hasn't changed. I also want to say there's a distinction between the technology sector and everything else, as we all know. So, yes, there's been a large pullback in the NASDAQ in excess of 10% from last Wednesday's peak. But there hasn't been nearly as much of a pullback in the rest of the world. It's only sort of down around 1%. The entire MSCI world, excluding United States indexes, down about 1 or 2%. And then the last thing I'll leave you with is that if you look at the previous corrections that happened very quickly, in other words, drops of 10% or more from the all-time high in the NASDAQ, there were around, well, actually 11 of them. There were 11 corrections of 10% or more that happened within a 3-week period or less since 1980. And the good news is that with only one exception, which was the year 2000, the dot-com bubble burst, the NASDAQ recovered quite handsomely over the next 6 and 12 months.
Right. Mark, do you see in this leg of the shakeout, there is going to be more gravitas and more attention towards the non-tech stocks and emerging markets? As a matter of fact,
I do think that as we get the gradually, improving news on the vaccines and therapies, and in America at least, the COVID cases are continuing to decelerate, the new cases. And as I'm sure you are aware, globally, for whatever reason, the current wave is not being accompanied by the same degree of mortality as that first wave back in the second quarter of this year. So yes, I believe that money will allocate into cyclicals, particularly stocks that have been most impacted by the coronavirus, the obvious candidates being hotels and airlines. Yes, I think that trade is there, but I also think that the next 5 years will still be a new economy story, and what we refer to as as technology. Is really creeping into all sectors of the economy. And so the last 10 years, we saw it impact primarily the retail sector. But over the next 5 years, I think you'll get it in healthcare, in financials, in so many different areas. And So I think that the most upside will still come from the digitalization of the economy, and that can happen most obviously in companies like Reliance Industries, but it can also happen from new companies that come out of nowhere, or existing companies in other sectors that reinvent themselves. So you have to choose, because not every company will be a winner in this. But I think that in emerging markets, including India, the digital economy is the place to be for the next 5 years. That's where you're going to get growth in the high double digits.
Sure, absolutely. And that's exactly what's playing out in the market as well, Mark, because the market is assigning this massive premium to Reliance and other platform companies. But where does that leave the traditional IT space, Mark? I mean, your TCS, Infosys, the HCL Technologies, and a clutch of these. Can they really try and gain a piece of the pie with the world getting digital, like you said?
Well, if they can, find a place in the new economy, absolutely. And I think those are, the kind of service providers that provide all the background, the support for companies. And absolutely, Salesforce would be a good example in America of a company that's just quietly in the background, but the number one provider of client interface and the platform we're using right now. So there's all kinds of things that are still able to provide service support. And yes, I think they will benefit from the increased digitalization of the economy. I do think so, yes.
Sure. Mark, in terms of asset classes as well, do you continue to feel that equities really are going to be the preferred choice going forward? We had that brief spurt, when it came to gold and even alternative asset classes like Bitcoin that were making headlines. But is it really going to continue to be equities all the way through the year?
I think the precious metals are still a very attractive asset class. It's not always going to go up every day, so they're building a base now. But there's every reason, I think, why they should still go up. And the biggest reason is that governments all over the world are moving gradually toward more fiscal stimulus. And that means more higher deficits, larger debt loads. Intuitively, that means paper currencies will depreciate versus real assets, and gold is obviously at the forefront of real assets. Of course, within the paper currencies, there will be ones that depreciate less versus real assets, but in general, I think that is a big trend for the next 5 years. And then with the fixed income space, there is value. We find it important, though, to be specific, because there are big differences in the fixed income market between deep junk, for example, or collateralized loan obligations. Basically, in the investment grade side, there's very little spread left, but you can find some in the high yield. You do have to be careful. Our preference is for double B to triple B and emerging market credit. And I must say our favorite right now outside of US dollar is Chinese bonds. You still get about a 3% yield in Chinese government bond. So that's a very good yield compared to the US at 0.7 or Germany at negative, that kind of thing.
Mark, what happens when the Fed stops printing money and, we start to see, we haven't seen an increase in stimulus at the rate at which perhaps Congress is, wanting to see results. But in that kind of scenario, what happens to the recovery?
It would obviously stall, but our premise is that the Federal Reserve and the other major central banks will not stop what they are doing. until the big economies of the world are fully reflated. So it's a question to be asked, but I think that they're not going to do it for a very long time. And in fact, on the back of the Jackson Hole statement, we pushed out our own assumption for when the Federal Reserve will raise short-term interest rates from 2022 to 2024. In other words, we think it's at least 4 years between now and when the Federal Reserve next raises interest rates. And that environment of extremely low interest rates, I think, is what's going to continue to provide support for risk assets.
Sure. Just looking at the market texture, it's a no-go really, 11,482. So it's a quiet start. The breadth, of course, is holding up. So that really is a comforting factor. You can't really drop any trend. You've got a Infratel holding up, CanBank, Jubilant Foods, Titan. That's where you're seeing some spurts of green actually build in. Mark, where is the contra opportunity in the market? Many believe that metals, because of the kind of uptick that you're seeing in hot rolled coal prices as well, coil prices, I beg your pardon, and the domestic demand as well is going to drive up metal prices even further. And the fact that most are still undervalued or under-owned in this particular space. And I'm talking about Indian steel manufacturers in particular over here. Do you believe there is meaty investment or perhaps even a short-term trade when it comes to metals?
Well, the one I look at is the copper price, and copper is even higher than it was prior to the COVID pandemic. So the metals have largely re-rated. In fact, we downgraded our own view on iron ore to an underweight last week because we felt that the metals recovery had gone too far. But I can't comment specifically on Indian metals. I can say, though, that to me, there is a gradual relaxation of a lockdown there, despite the second wave in the cities in India. It's interesting that the unlock 3.0 phase is pressing ahead, and I sense that the central government and the states are more interested in trying to get economic activity to continue to improve than going for another lockdown. So from a stock market perspective, that's of course a positive. And so on that basis, if you get a continued cyclical recovery in India, and the numbers I see suggest the economy is still about 20% lower than where it was before the epidemic, then as I said, I'm not familiar with the metal prices in India specifically, so I can't give you a buy or sell recommendation on them. But intuitively, based on what I just said, there should be more of a cyclical recovery, which obviously metals like that kind of thing.
Sure, I got your point completely. Mark, thanks so much for taking the time out and speaking with us. Good to have you on the show. Still pretty quiet and tentative for the market. Just look out for what banks are up to.